Let me ask you something. If you had $200,000 sitting in your account right now, how would you feel? Proud? Relieved? Maybe stuck? Because here's the truth no one talks about. 200K is a strong position, but it's not freedom. It's not never work again money. It's not generational wealth. It's not private jet lifestyle. And that's why it feels weird. Too big to ignore, too small to retire. Most people with 200K make one of two mistakes. They either leave it sitting in a safe account earning 2%, or they freeze, afraid to mess it up. And that's where wealth quietly dies. Because 200K is not the finish line. It's a launch pad. Today, I'm going to show you the math, not hype, not motivational quotes, but real, historical, boring math that turns $200,000 into $1 million plus. No lottery tickets, no day trading, no crypto moonshots, just compounding. And once you see this, you'll never look at money the same way again. Here's the part that changes everything. At a 10% average return, which is roughly the long-term historical return of the S&P 500 with dividends reinvested, your money doubles every 7.2 years. That's not magic, that's math. So 200K becomes 400K, then 800K, then $1.6 million without you adding a single extra dollar. Now here's the scary part. If you leave that same 200K in a 2% savings account, it could take 80 years to reach $1 million. 80. You'd be investing for your great-grandchildren. That's the difference between understanding money and letting money quietly waste your life. In this video, I'm breaking down the safe trap, the standard path, the optimized S&P 500 route, the aggressive Nasdaq sprint, and the secret acceleration strategy that can cut decades off your timeline. Because the truth is this: 200K is not stuck. It's either asleep or it's about to become a machine. Let's wake it up.
All right. Before we talk strategies, before we talk ETFs, before we talk real estate, you need to understand one concept, one rule, one tiny formula that explains almost all wealth creation. It's called the Rule of 72. And this is where the mind-blowing part begins. The Rule of 72 says, take 72, divide it by your annual return. That tells you how many years it takes your money to double. That's it. No PhD required. Let's test it. If you earn 10% per year, which is close to the historical long-term average of the S&P 500 when dividends are reinvested, 72 divided by 10 equals 7.2 years. That means every 7.2 years, your money doubles. Now apply that to $200,000. Year 0, $200,000. Year 7, $400,000. Year 14, $800,000. Year 21, $1.6 million. Pause. Look at that. You didn't need a side hustle. You didn't need 15 rental properties. You didn't need to predict the next AI stock. You just needed time and math. Now, let's compare that to something safe. Say your money earns 2%. 72 divided by 2 is 36 years to double. So, year 0, $200,000. Year 36, $400,000. Year 72, $800,000. Year 108, $1.6 million. That's 3 generations. That's not safe. That's slow destruction. Here's what most people miss. Compounding doesn't grow linearly. It grows exponentially. The first 7 years feel boring. The second 7 years feel exciting. The third 7 years feel unstoppable, because the real wealth jump happens after the second double. This is why the wealthy don't obsess over monthly gains. They obsess over annual average return, because a 3% difference in return doesn't look dramatic today. But over 20 years, it's the difference between comfortable and wealthy. And now that you understand the doubling clock, we can start choosing the path. Let's start with the path most people take, the safe one. You've got $200,000. You worked hard for it. You don't want to lose it. So you park it in a high-yield savings account at 2%. Sounds responsible. Sounds conservative. Sounds smart. But let's run the math. At 2%, using our rule of 72, your money doubles every 36 years. So here's the timeline. Year 0, $200,000. Year 36, $400,000. Year 72, $800,000. Year 80 plus, finally crossing $1 million. 80 years. That's not investing. That's preservation at best. And here's the uncomfortable truth. Inflation historically averages around 2 to 3%, which means at 2%, you're barely keeping up. In real terms, you might actually be losing purchasing power. This is what I call the safe trap. It feels calm, but it quietly kills momentum. Now let's move to the standard path. This is the diversified investor. Broad market exposure, balanced portfolio, long-term mindset. Historically, a 60-40 stock-bond mix has averaged around 7% annually over long periods. Now apply Rule of 72. 72 divided by 7 equals about 10.3 years to double. So year 0, $200,000. Year 10, $400,000. Year 20, $800,000. Year 24 to 30, $1 million plus. Now we're talking. Instead of 80 years, we're down to roughly 25. That's one working career. But here's the psychological challenge. The first 10 years feel slow. You go from 200K to 400K. Nice, but not life-changing. The magic happens in years 15 to 25, because compounding stacks on itself. This is why discipline beats emotion. The standard path won't impress your friends at dinner. It won't go viral, but it works. And for many people, 7% is enough. But if you want to compress time, if you want the math to move faster, we need to talk about the optimized path. Now we step into optimized territory. Not reckless, not speculative, just historically powerful. Let's talk about the engine of American wealth creation, the S&P 500. For nearly a century, this index, representing 500 of the largest U.S. companies, has averaged around 10% annually when dividends are reinvested. Not every year. Some years are brutal. Some years are incredible. But over long periods, about 10%. Now plug that into our doubling formula. 72 divided by 10 equals 7.2. So your $200,000 becomes year 0, $200,000. Year 7, $400,000. Year 14, $800,000. Year 17, $1,000. 17 years. That's the difference between retiring at 67 and potentially having options at 50. And here's the crazy part. You don't need to stock pick. You don't need insider knowledge. You don't need to time recessions. A simple, low-cost index fund tracking the S&P 500, reinvesting dividends, historically does the heavy lifting. This is the part most people underestimate. Dividends matter. When dividends are reinvested, they buy more shares. More shares generate more dividends. That's the snowball. That's the machine. That's why the math accelerates. And here's something even more powerful.
You don't need to add more money. Just letting 200K sit in this engine could historically reach $1 million in under 2 decades. Zero extra work. Now, is it guaranteed? No. Markets fluctuate. There will be crashes. There will be scary headlines. But historically, patience plus reinvestment has rewarded discipline. This is why the wealthy focus on ownership of businesses, ownership of productive assets, because ownership compounds. But what if you want faster? What if 17 years still feels long? That's when we look at the aggressive edge. Now we're stepping into higher volatility territory, higher risk, higher potential reward. Let's talk about the tech-heavy growth engine of the market, the Invesco QQQ, which tracks the Nasdaq 100. This isn't the full market. This is concentrated innovation, technology, AI, cloud computing, semiconductors, digital infrastructure. Over the last decade, the Nasdaq 100 has averaged roughly 20+% annually. Now, very important, that is not guaranteed going forward. That's recent history. But let's explore the math. If you earned 20% annually, 72 divided by 20 equals 3.6 years to double. That means year 0, $200,000, year 3.6, $400,000, year 7.2, $800,000, year 9, around $1 million. 9 years. That's the sprint. Now, let's bring it back to reality. Long-term, a safer assumption for aggressive growth might be closer to 12 to 15%. At 12%, 72 divided by 12 equals 6 years to double. So, year 0, 200K, year 6, 400K, year 12, 800K, year 15 to 17, $1 million plus. Even at 12%, you're potentially cutting years off the standard S&P timeline. But here's the trade-off. Higher returns come with deeper drawdowns. The Nasdaq can drop 30, 40, even 50% in brutal markets. If you panic and sell, the math breaks. Compounding only works if you stay invested. This is the emotional tax of aggressive investing. You get speed, but you must tolerate turbulence. This is why many investors combine approaches. Core S&P 500 exposure for stability, plus targeted growth exposure for acceleration. Not gambling, not chasing trends, strategic aggression. Because remember, the goal isn't excitement. The goal is compression of time. But there's a secret way to compress time even further, and it doesn't require chasing higher returns. It requires adding fuel. Here's where things get powerful. Because most people think wealth is only about rate of return. It's not. It's about rate plus contribution. This is the acceleration lever. Let's go back to our standard path. $200,000 invested at 7%, roughly 25 to 30 years to reach $1 million. Now let me ask you something. What if you added just $500 per month? Not $5,000, not $2,000, just $500. That's $6,000 per year. Now run the math. Instead of waiting nearly 30 years, you can potentially cut that timeline down to around 20 years. That's a decade of your life reclaimed. And here's the crazy part. The impact gets even stronger at higher returns. At 10%, similar to the historical average of the S&P 500, adding just $125 per month can potentially turn $200,000 into nearly $1 million several years faster than doing nothing. Small inputs, massive long-term output. This is the snowball effect in action. Your $500 contributions buy more shares. Those shares earn returns. Those returns buy more shares. Those shares earn returns. It's exponential stacking. This is why reinvesting dividends matters so much.
Dividends are automatic contributions. They're hidden accelerators. If you turn off dividend reinvestment, you slow the snowball. If you reinvest consistently, you amplify it. Now let's zoom out. Imagine this strategy over 20 years. Even modest monthly additions can add hundreds of thousands of dollars to your final balance, not because you became a genius investor, but because you respected time. This is what separates 99% of people from the 1%. The 99% chase higher returns. The 1% increase contributions and stay consistent. Return matters, but behavior matters more. And if you really want to compress time dramatically, there are alternative fast tracks. They're not passive, they're not easy, but they can multiply capital quickly.
Now, let's talk about the shortcuts, the alternative fast tracks that some investors use to turbocharge 200K. And no, I'm not talking about risky day trading or hoping a meme stock goes viral. I'm talking about real estate, specifically strategies that experienced investors use to potentially double or triple money in years, not decades. One example, the BRRRR strategy. Buy a property below market value, rehab it, rent it out, refinance to pull cash back, repeat. With the right market and management, some investors see 100% gains in 2 to 5 years per property. Now, combine that with syndications or private deals. Real estate syndications pool capital to invest in larger commercial projects. Experts often aim to double investor money in 3 to 5 years thanks to rental income, appreciation, and leverage. This isn't guaranteed. There are risks, market downturns, vacancies, management issues. But for someone with 200K, investing 50K to 100K into a syndication could potentially provide a big multiplier on your core portfolio. Here's the catch. These fast-track strategies require involvement, research, and trust. You can't just hand your money to anyone. You need vetted sponsors, solid contracts, and a realistic expectation of returns. Yet, when done right, these methods can compress timelines dramatically. 200K invested in an aggressive Nasdaq ETF, approximately 9 to 17 years to 1 million. 200K invested in the S&P 500, 17 years to 1 million. 200K in BRRR or syndication deals, potentially under a decade if everything clicks. But before you jump in, remember the wealth killers. Inflation erodes purchasing power. Taxes reduce net gains. High fees silently eat profits. Shield against these using tax-advantaged accounts. 401k or RRSP for tax deferral. TFSA for tax-free growth. ISAs in the UK for shielding returns from capital gains. Fast tracks are exciting, but only if you manage the risk and protect your gains. At the end of the day, acceleration isn't about luck. It's about time, contributions, and smart leverage. Let's bring this all together. $200,000 is not stuck. It's not a ceiling. It's a launch pad. The math is simple. Save 2% savings, 80 years to 1 million. Standard 7% portfolio, 25 years. S&P 500 at 10%, 17 years. Aggressive Nasdaq 12 to 20%, 9 to 17 years. Real estate and syndications, potentially under 10 years. The secret isn't flashy. It's discipline. It's patience. It's consistency. Add a little each month. Reinvest dividends. Let time work its compounding magic. The wealthy don't chase shortcuts. They apply proven math. They avoid wealth killers, high fees, taxes, and letting money sit idle. And yes, there will be volatility. There will be uncertainty. There will be temptation to do something different. Ignore it. Follow the math. Follow the plan. Trust the process. Because here's the emotional closure. Most people looking for shortcuts fail. They panic during drops. They spend what could have compounded. They settle for safe money that slowly dies. But those who respect compounding, add consistent contributions, and understand the acceleration levers, they win.
Not because they're luckier, not because they took risks blindly, but because they let math do the work. So if you have $200,000 today, don't treat it as just a number. Treat it as a machine, a compounding engine, a foundation for long-term wealth. Wake it up, accelerate it, protect it, and in 10, 15, or 20 years, when the doubling clock has done its magic, you'll thank yourself for understanding the mind-blowing math behind turning 200K into millions.